At the beginning of 2020, billionaire hedge fund investor Bill Ackman executed one of the greatest trades in history, turning just $27 million into $2.6 billion in just 30 days. But when Ackman revealed this trade to his clients, people were not happy. And this wasn't just a case of anger towards a rich man getting richer while the world grappled with a collapsing economy. The critique of Ackman's trade has everything to do with how he did it.
I do right now, though, want to bring in Bill Ackman on the phone. Bill, I thank you for joining us today.
On the 18th of March 2020, Bill Ackman called into CNBC for a 28-minute interview.
Draw down their credit lines because hell is coming. I've never had this experience before in my life. The closest I had was the financial crisis where I'm saying, bad stuff's coming.
On the verge of tears, he expressed a view that the spread of COVID could be the end of America as we know it.
America will end as we know it, okay? I'm sorry to say so, okay? Unless we take this option. The tsunami's coming in, you feel it in the air, right? The tide starts to roll out, okay? And on the beach, people are playing and having fun like there's nothing going on. And that is the feeling I've had for the last 2 months.
The stock market was down 5% when the call started, but plunged to be down over 7% during the interview, falling so fast that trading had to be halted for 15 minutes. Small public companies were down 10% just in that trading session. What wasn't known at the time was what Bill Ackman was doing while he stoked fear on the biggest finance network in the world. Well, he was offloading a multi-billion-dollar bet on corporate bankruptcies. So while he sat there live saying things like this,
Hilton is the canary in the coal mine, down from like 120 to 50. Okay, it's going to zero. Every hotel company in the world, okay, is done.
He was selling billions of dollars of insurance protection against businesses failing. Oh, and with the money, he was buying stocks, which, by the way, were getting cheaper every minute he spoke. Unsurprisingly, Ackman faced enormous backlash for inciting market panic while he profited from it. But this story is so much deeper than just this interview. So let me explain Ackman's trade and whether or not he used public influence to make it work. Bill Ackman is one of the biggest names in finance. The investment firm he runs, Pershing Square, has been investing billions of dollars for decades. But in the lead up to 2020, it was certainly not smooth sailing. Between 2015 and 2019, his fund shrank by about $9 billion as he took on large losses from high-profile bets on Valiant Pharmaceuticals and another against Herbalife Nutrition. I'll be specifically diving into these stories in another video, so make sure you're subscribed if you don't want to miss them. The underwhelming returns drove many clients to withdraw their money from the fund, but with a very strong 58% return in 2019, he was still managing about $6.5 billion. Most of the money was invested in a concentrated basket of public companies. Chipotle Mexican Grill, Restaurant Brands International, Hilton Hotels, and Lowe's made up the majority of his portfolio. The success of his fund in 2020 was going to rely almost entirely on the performance of just 4 stocks, and that wasn't even the worst part. This is the concentration of Ackman's exposure to industries at the end of 2019. 40% invested in restaurants, 16% in hospitality, and 14% in retail. You can probably see where I'm going with this. Pershing Square was very vulnerable to a pandemic.
The hotel industry and the restaurant industry will go bankrupt first. Boeing is, on the brink. Okay? Boeing will not survive without a government bailout.
January of 2020 saw markets continue to build on the previous year's rally, but the peak came on the 19th of February. In the last week of the month, stocks began falling sharply. By the 3rd of March, there was already 90,000 confirmed cases of COVID-19 globally, with over 3,000 reported deaths. But it was the reality of widespread COVID cases coming to the United States, which ultimately triggered the stock market collapse. I want to draw your attention to these numbers here. At the start of February, the credit spread on US corporate bonds was just 0.6%. The credit spread is how much extra a corporate bond yields over a US Treasury bond. In plain English, it's the additional return you earn for lending to a corporation to compensate for the additional risk. If you lend money to a corporation by buying a corporate bond, there's a small chance that they don't pay you back, that they default on that loan. And so the credit spread also tells us what investors think about the likelihood of corporations corporations defaulting. When the spreads are very narrow like they were at the beginning of March 2020, investors believe the risk of corporate defaults is very low. Bill Ackman watched as the virus spread around the world and realized two very important things. Firstly, if COVID was to spread around the United States like it had at other countries such as China at the time, then his specific investments, would face the biggest impact. And also that no one was really worried about the many bankruptcies that would come with it. On the 3rd of March, Ackman published a letter to his shareholders. During the past 10 days, we have taken steps to protect the portfolio from downward market volatility. We believe efforts to contain the coronavirus are likely to have a substantial negative impact on the US and global economies and on equity and credit markets. The letter didn't explain exactly how he was protecting his investments, except that he'd bought large notional hedges with asymmetric payoff characteristics, meaning the potential loss from the trade was fairly small, but that the payoff would be massive if COVID really did get significantly worse. By the way, that small potential loss could have been in the hundreds of millions of dollars, so making sure this trade hit big was pretty important. The bet Ackman made was to buy credit protection on investment grade and high yield credit indices. They're called credit default swaps, and that name might sound familiar because it's the same financial instrument Michael Burry used to bet on mortgage bonds failing in 2007, a trade famously known as the Big Short. A credit default swap is like insurance you can buy against a bond. For example, if I think American Express is going to default on its bonds, I could buy a credit default swap. I'd pay monthly premiums for the protection, and just like an insurance policy, if American Express defaults, I get paid out. But if I wasn't worried about a specific company, but rather a general rise in corporate bankruptcies, I could use a credit default swap index. Same concept, but I'm paying premiums for protection on a basket of corporate bonds. This is what Ackman did, and while we don't know all of the specific numbers, this is approximately how it worked. Ackman bought protection against about $65 billion of corporate bonds. Credit spreads at the time were about 0.5%, so the cost of this insurance policy would be about $325 million per year for 5 years, which is about $27 million per month. Again, in plain English, Ackman was able to buy protection against corporate bankruptcies for really, really cheap. And so if the risk of corporate defaults was to rise, then the value of his contracts would rise significantly. Think of it like you've locked in a 5-year contract to pay just $1 a month for Netflix. Today, if anyone wants to sign up to Netflix, they have to pay $25 a month. So someone would be willing to pay a hell of a lot of money up front to control my $1 per month Netflix subscription. Just 6 days after announcing the bet to his shareholders, he provided another update. On March 9th, he revealed that the trade was already doing very well. The value of his fund's net assets had now risen 2.8% for the year, while the stock market was down nearly 10%. The next time that we heard from Bill was the morning of the 18th, the day of the CNBC interview. By now, the market had fallen more than 25% from its peak, and Ackman was busy posting his thoughts on Twitter. In a 4-tweet thread, he essentially begged President Trump to completely shut down the US for 30 days, arguing that delaying an inevitable lockdown would destroy the economy. Throughout the morning, stocks fell over 5% before Scott Wapner asked him to call into the halftime report on CNBC for an interview.
Bill, I thank you for joining us today.
The next 28 minutes could only be described as bizarre.
I woke up with a nightmare. Friends and family are going to die. What's going to happen if we continue the way we are operating? We will go through a depression-era period.
He would provide a very deeply negative view of what was to come.
Okay, because no business can survive a period of 18 months without revenue.
He spoke about one of his biggest investments, Hilton Hotels.
You say Hilton is going to zero? I mean...
No, again, I'm a major shareholder. What I'm saying is every hotel company in the world, okay, is done.
Saying with a shaky voice that all hotel companies are going to zero is pretty much as negative as you could possibly be. But what was really strange about this was in between his very long monologues about how it's the end of the world, he also made time to disclose that he was buying stocks.
But I got bullish, okay? And the reason why I got bullish, and I've been aggressively buying stocks, including Hilton, today.
Which just made the entire interview really confusing. After the interview, he tried to clarify his remarks on Twitter, writing that he believed the president would shut the country down, and that's why he was buying stocks. Bargains of a lifetime, he called it. Many people were confused as to why he sounded so scared during this call, and yet he was so confident that things would be better in a few weeks that he was buying stocks left and right. The answer came just a week later. On the 25th of March, Ackman published another letter to his shareholders, stating, "On March 23rd, we completed the exit of our hedges, generating proceeds of $2.6 billion for the Pershing Square funds, and the price of the bet being just $27 million. Not only that, he'd also taken most of the $2.6 billion and bought shares in companies like Berkshire Hathaway, Hilton, Lowe's, and restaurant brands. So around the time of his CNBC interview, Ackman would have greatly benefited from increased fear in the markets. More fear would have meant selling his credit default swaps at higher prices and being able to buy stocks in the companies he already owned at even lower prices. Facing a ton of pressure, Ackman released yet another statement, this time providing a much more detailed timeline of his bet. He revealed that the firm began selling the credit default swap position on the 12th of March, a week before the interview, but that given the size of the trade would take days to fully exit. Importantly, the position was worth $2.75 billion on the 12th, so, quote, the hedge didn't increase in value during or after being on CNBC. The increase in the value of his bet was violent, and I really want to explain exactly how that works. Earlier in the video, I explained that Ackman was paying $27 million a month for what was essentially an insurance policy against corporate defaults. He did this at a time where credit spreads were about 0.5%, so he had protection against $65 billion of bonds. In the few weeks that followed, credit spreads expanded to about 1.4%, which just means that investors were paying much more for default protection than they were previously because of the increased risks associated with the pandemic. So if someone on the 12th of March wanted to protect the same $65 billion worth of bonds, it would now cost $910 million a year in premiums for 5 years, which is $76 million a month. Or they could just buy the contracts that Ackman held, which had premiums of just $27 million a month. Or, in other words, the value of his contracts is now just the present value of the difference in premiums between the two contracts. 76 million minus 27 million, which is 47 million per month for 4 years and 11 months, which is $2.75 billion. Obviously, the main reason why this bet worked so well was because credit spreads widened in such a significant way, but it also has a lot to do with how quickly the bet paid off. Ackman really only had to pay premiums for 1 month. He only had to pay one set of $27 million per month in premiums before this bet paid off. So the 27 million figure into 2.6 billion really understates the risk of this trade. If, for example, this trade, if credit spreads had just stayed the same for 6 months instead of increasing so quickly, then Ackman would have been paying premiums for 6 months, which would have been a cost of hundreds of millions of dollars. It's obviously impossible to know for sure whether Ackman's CNBC appearance had any meaningful impact on markets and or the value of the bet. What we do know is it was undoubtedly one of the greatest trades of all time. While the stock market sank 17%, Pershing Square's public fund had a 7.9% gain in March 2020. And today, Ackman's firm manages a whopping $16 billion. Subscribe if you enjoyed and check out one of these videos next.